Do you know who has the best rates on home equity loans? I don't even know what that means. Did you know there's a platform where you can lend and borrow money without getting approved by a bank? Yeah, no middlemen, just peer-to-peer lending through cryptography. Is that legal? Well, yes, it's called DeFi, decentralized finance. And in this video, I'm going to break down how lending, borrowing, and earning yield sparked the DeFi revolution. Let's dive in. Hey everybody, welcome back to the channel. If you're new around here, I cover everything you need to know about the business of crypto, NFTs, and the metaverse. So if you're interested in making money in Web3, then make sure to hit the subscribe button because we drop a new video every week. So let's get into this DeFi stuff. Before DeFi, the world ran on traditional finance, aka trade fix. If you want a loan, you go to a bank. If you want to earn interest, you open a savings account. But there's a catch. Banks decide who qualifies, who gets a loan, and at what interest rate. They set the rules and often take the biggest share of the profits. This created massive gatekeeping institutions, a financial system controlled by the few. In fact, 1.7 billion people worldwide are unbanked, excluded from financial services altogether. So the question was, could blockchain change this? Could DeFi, aka decentralized finance, make finance more open, accessible, and fair? We're about to find out. This is a story that begins in 2017 and 18, when Ethereum really became the sandbox of financial experiments. In 2017, MakerDAO created the first decentralized stablecoin called DI. Now, before we get too deep into how this works, you need to understand what a stablecoin is. Basically, it's a crypto token that's pegged to the price of another asset, most commonly the US dollar. So one DAI should always be equal to one US dollar. But instead of being issued and backed by a central authority like a government or a bank, DAI is algorithmically regulated by a smart contract, a piece of code that lives on the blockchain. And this code allows anyone to mint new stablecoins by putting up collateral. At the time, Ethereum was the most popular collateral asset used to mint DAI, and here's why. Ethereum's price fluctuated, which meant that if you put up ETH as collateral, the value of your collateral would go up or down depending on the price of ETH. So the system had to keep the amount of DAI in circulation in check to make sure that if the price of ETH fell, you wouldn't be able to mint infinite amounts of stablecoins that aren't backed by anything. In other words, if the value of your collateral dropped, you'd have to put up more collateral to maintain the same amount of DAI you already minted. Sounds complicated? Don't worry, we'll come back to this. Anyway, once MakerDAO launched DAI in November of 2017, soon after, two big players entered the market, Compound and Aave, launching lending and borrowing markets where anyone could deposit their cryptos, earn interest, or borrow against collateral. But how did these platforms work? Well, we're about to find out. It's 2018 and you're hanging out in your favorite chat room reading up on the latest crypto trends. You hear some buzz about this cool new way to earn interest on your idle crypto, so you sign up to test it out. First, you choose between being a lender or a borrower. As a lender, you deposit your assets, aka provide liquidity to a liquidity pool, a smart contract that holds everyone's deposited funds. You then earn interest on your deposit, which is added to your account over time. Pretty sweet, but what if you want to borrow? But what if well, as a borrower, you put up collateral, usually double the amount you plan to borrow, and then you receive a loan in return. So for every $100 you want to borrow, you'll lock up $200 worth of collateral. These platforms used algorithms to set interest rates so that lenders are incentivized to supply assets to the protocol, and borrowers are incentivized to take out loans and repay them on time. This was groundbreaking. For the first time, users could supply their crypto to earn interest and borrowers could get loans without going through a bank. Plus, it was all automated, transparent, and available 24/7. No paperwork, no credit checks, just code. So what happens if a borrower doesn't repay their loan? Well, that's where collateral comes in. If a borrower defaults, aka doesn't pay back, lenders get repaid first from the borrower's collateral. This creates an incentive for borrowers to repay because if they default, they could lose their collateral. For example, if a borrower puts up $200 worth of ETH as collateral and only borrows $100, but they don't repay, the lender will take the full $200 of ETH. That said, if the borrower does repay, the lender still earns interest on their loan, creating an incentive for both parties to stay on the up and up. But this brings up a good point. Why use crypto as collateral when you could use a stablecoin like DAI? Well, since DAI is a decentralized stablecoin backed by ETH, it had the same volatility risk as ETH, meaning its price could fluctuate, which could lead to liquidation, aka losing your collateral. This is why platforms like Compound and Aave chose to use crypto as collateral, because its price fluctuations are much easier to predict than a decentralized stablecoin. So how do these platforms make money? They charge interest on all the money that they facilitate. So for every dollar loaned out, they make a percentage. For example, if someone borrows $1,000 and pays 5% interest, the platform makes 50 cents and shares it with shareholders. But wait a minute. I thought you said decentralized finance, which means anyone can use it anywhere. Doesn't that mean it's unregulated? Yes and no. It's not regulated by a central authority like a government or a bank, but it is regulated by code. Every transaction on the blockchain is visible and auditable, which means you can track every single detail of a user's activity, which gives regulators unprecedented insight into users' financial behavior. But this also means users must be extremely careful when transacting, because every action is permanent and irreversible. That said, the real breakthrough came in 2020, when DeFi introduced something new: yield farming. Remember those governance tokens I mentioned earlier, the ones that represent ownership in a protocol like Comp or Aave? They can be farmed for providing liquidity to these protocols. So here's how that works. If you provide liquidity to a protocol like Compound, you earn interest on your deposit. But now you're also rewarded with governance tokens like Comp. Now this seems like a little extra, but it actually changed everything. All of a sudden, providing liquidity wasn't just about passive yield, it was about becoming an owner in the protocol itself. So if the protocol makes money, you make money. This unlocked a whole new level of engagement and excitement around DeFi, kicking off the famous DeFi Summer. Overnight, billions of dollars flowed into decentralized platforms. Interest rates skyrocketed, exceeding 10% for supplying basic assets like ETH or stable coins. The total value of assets locked in DeFi surpassed $1 billion for the first time, proving that people want open, decentralized financial products. Of course, DeFi isn't perfect. The same openness that creates opportunity also creates risk. Smart contract bugs, rug pulls, flash loan attacks all are part of the game. And while collateralized lending ensures repayment, it also means borrowers must lock up far more value than they receive. Despite the risks, though, DeFi is growing exponentially. Total value locked has grown to over $100 billion since its launch. New platforms continue to enter the space, and legacy financial institutions are taking notice. Goldman Sachs has dipped their toes in DeFi, Bank of America sees huge potential, and JP Morgan is bullish on the technology. While DeFi still has challenges to overcome, it's clear that something big is happening. The DeFi revolution showed us this. Finance can be open, permissionless, and global. Anyone with an internet connection can lend, borrow, or earn yield. But innovation comes with responsibility, to understand the risks and to build safer systems. If you enjoyed this breakdown, hit like, subscribe, and stay tuned here on DCA Crypto, where we decode the future of decentralized finance. See you next time.